Before we begin, it's crucial to understand that the information provided in this video is for educational and informational purposes only. I am not a licensed financial advisor, mortgage broker, or real estate attorney. The home buying process is complex and involves significant financial and legal commitments. You should always consult with qualified professionals, such as a financial advisor, a mortgage lender, and a real estate attorney, to get advice tailored to your specific situation before making any decisions. This presentation is not intended as a substitute for professional advice. You're probably using the words mortgage and home loan completely wrong, and that simple, everyday mistake is a symptom of a much bigger problem. A problem that could cost you tens of thousands of dollars, add years of payments to your debt, and turn the American dream of homeownership into an absolute nightmare. That sounds like an exaggeration, right? It's not, because the people who lend you hundreds of thousands of dollars are counting on you not knowing the difference. They thrive on the confusion. They build their empires in the fine print you think is just standard paperwork. Imagine this for a second. You did it. You saved for the down payment, you got pre-approved, you beat out 5 other offers, and you finally got the keys to your dream home. You're celebrating, posting pictures online, picking out paint colors. Life is good. Then 18 months later, a letter shows up. It's from your lender. It's dense, full of legal jargon, but you find the one line that matters. Your monthly payment is going up by $300, then $400. You panic. You call the 1-800 number, and a representative on the other end starts throwing around terms like adjustable rate, escrow shortage, and negative amortization. And in that horrifying moment, you realize the truth. You didn't just sign up for a home loan. You signed a very specific, very dangerous type of mortgage that you never truly understood. This scenario isn't just a scary story. It happens to thousands of American families every single year. And it all starts with the simple misunderstanding of the words we use. So here's my promise to you. In this video, we are going to shatter that confusion. We are going to arm you with the knowledge that puts you back in control. You will walk away from this knowing with absolute certainty the real difference between a home loan and a mortgage. But more importantly, you're going to understand why it matters. You will learn the language the banks use, not so you can sound smart, but so you can spot the traps, ask the right questions, and negotiate from a position of power, not desperation. This isn't just a vocabulary lesson. This is your financial armor for the biggest purchase of your life. We are going to pull back the curtain on the entire industry, and it all starts with this one foundational concept. Alright, let's get into it. For most people, the terms home loan and mortgage are interchangeable. You use them to describe the same thing, the giant pile of money you borrow to buy a house. And on a casual conversational level, that's fine. But when you are sitting at a closing table with a stack of documents an inch thick in front of you, casual conversation is over. At that point, words have immense legal and financial power. Here is the single most important takeaway. A home loan is the what. A mortgage is the how. Let that sink in. A home loan is the general concept. It's the product. It's the bank agreeing to lend you $300,000 so you can buy a property. That's the what. It's the money. A mortgage, on the other hand, is something entirely different. The mortgage is the legal instrument. It's the specific legally binding contract that outlines how you will secure that loan. It's the document that says, I am pledging this house, this physical property, as collateral for the money I'm borrowing. The mortgage is the teeth. It's the enforcement mechanism. It's the or else clause in your agreement. Think of it like this. Let's say you want to get across town. The general concept, the what, is transportation. But you don't just walk into a dealership and say, give me one transportation. You need to know how you're getting it. Are you buying a car? Are you leasing a car? Is it a 36-month lease with a mileage limit, or a 72-month financing agreement? Each of those houses comes with a completely different set of rules, risks, and financial obligations. Buying the car means you own an asset. Leasing it means you have a strict set of rules and you have to give it back. A home loan is transportation. A mortgage is the specific lease or purchase agreement you sign. And just like with a car, confusing the two can lead to disastrous consequences. You might think you're buying, but you've signed up for terms that feel more like a very, very expensive rental. So why is this distinction so critical? Because the term home loan is passive. It implies a simple transaction. The bank gives you money, you pay it back. Feels safe. The word mortgage, however, is all about power and security for the lender. The word itself comes from Old French, meaning debt pledge. It was a pledge that dies either when the loan is fully paid off, or when the borrower fails to pay and the property is seized through foreclosure. That's what the mortgage document does. It creates what's known as a security interest or a lien against your property. It's a legal claim. It gets recorded in your county's public records, telling the entire world that even though your name is on the deed, someone else has a primary financial stake in your home. This document is the lender's insurance policy. It is the piece of paper that gives them the legal right to kick you out and sell your house if you break the promises you made. When you understand this, your entire perspective shifts. You stop seeing it as just my loan payment, and you start seeing it for what it is. A high-stakes agreement where your family's home is on the line every single month. This isn't to scare you. It's to empower you. Because when you understand the gravity of the mortgage document, you start paying a lot more attention to the details inside it. And those details are where the real game is played. Within that mortgage document are all the rules of engagement. What's the interest rate? Is it fixed for 30 years, or can it suddenly change after year 5? That's in the mortgage. Are you required to pay property taxes and homeowners insurance through an escrow account controlled by the lender? That's in the mortgage. Are there penalties if you try to pay the loan off early? That's in the mortgage. What are the specific conditions that could trigger a foreclosure? It's all in there. So when a lender says, "Don't worry, it's just a standard home loan," what you should hear is, "Let's find out exactly what type of mortgage this is and what specific rules I'm agreeing to." The home loan is the money. The mortgage is the rulebook, written by the bank's lawyers, for the bank's protection. Your job is to understand that rulebook better than anyone else at the table. And that is exactly what we are going to do. Now that you understand this foundational difference, the what versus the how, we can start to dissect the rulebook itself. We can finally start to answer the questions that truly matter. Questions that can save you a fortune and protect your family. Questions like, what is the difference between a conventional loan and an FHA loan? What is a fixed-rate mortgage versus an ARM, and how do you know which one is right for you? And what is the single most predatory clause hidden in mortgage documents that you need to watch out for? Understanding that a mortgage is not just a loan is the key that unlocks all of these answers. It's the first, most critical step to transforming yourself from a confused buyer into a confident, educated homeowner. The power dynamic shifts the moment you know what to look for. And we're just getting started. So let's start with the most fundamental question of all, the one that's right there in the title. Mortgage versus home loan. Are they the same thing? Does it even matter? The answer is no, they are not the same thing. And yes, it matters more than you can possibly imagine. In fact, understanding this one single distinction is like being handed a secret map to a treacherous landscape everyone else is stumbling through blind. For most people, the words are interchangeable. You hear your friends, your family, even real estate agents use them as if they mean the exact same thing. I'm going to the bank to get a mortgage. We just got approved for our home loan. This casual confusion is the fog that keeps buyers at a disadvantage. Because the bank, the lender, they know the difference. They understand it down to the last comma on the last page of a 100-page document. And their understanding of that difference is the source of their power. Today we take that power back. Here's the simplest way to think about it. The home loan is the story. The mortgage is the signature at the end, written in blood. Let's unpack that. The home loan is the entire process. It's the broad, overarching journey you go on to borrow a massive sum of money. It's the quest. It starts the moment you decide you want to buy a house and you need financing. It includes the application where you lay your entire financial life bare. Your pay stubs, your tax returns, your bank statements, every late payment you ever made on a credit card back in college. This is the part of the story where you, the hero, have to prove your worth. You have to show the gatekeepers, the loan officers, the underwriters that you are a reliable, trustworthy person. Your credit score is your reputation in the kingdom. Your debt-to-income ratio is a measure of your strength and your burdens. The home loan is the narrative of your financial past and the promise of your financial future. It's the negotiation, the back and forth, the approval, the conditions, and finally the glorious moment when the lender says, "Yes, we will fund your quest." Here is the treasure you need to acquire the castle. The home loan is the money itself. It's the pile of digital gold that gets wired to the seller on closing day. So if the home loan is the quest and the treasure, what is the mortgage? The mortgage is the dragon. It's the legal instrument, the actual document that gives the entire deal its teeth. It's the binding contract that says, "We, the lender, have given you this treasure. In return, you pledge the castle itself as collateral." The mortgage is what gets filed with the county recorder's office. It's a public declaration that even though your name is on the deed, there is a powerful primary claim against your property. A lien, a chain that connects the lender directly to your home. This is not just poetry. The word mortgage itself tells a dark, revealing story. It comes from two old French words, mort, meaning dead, and gage, meaning pledge. A dead pledge. Historians debate the exact origin, but the most compelling theory is that it represented a pledge that dies in one of two ways. Either it dies when the loan is fully paid off, you vanquish the dragon, the pledge is fulfilled, and the castle is truly yours. Or the property becomes dead to you if you fail to pay. The pledge is broken, and the dragon awakens. The mortgage is the document that gives the lender the legal right to foreclose on your home, to seize the property, and sell it to get their money back. So let's put it all together. You apply for a home loan. You get approved for a home loan. You use the funds from the home loan to buy the house. And at the closing table you sign a mortgage. You are willingly chaining a dragon to your front door as a guarantee that you will pay back every single penny of the home loan, plus interest. The loan is the opportunity. The mortgage is the obligation. The loan is the bank's risk on you. The mortgage is your risk on the house. Now you might be thinking, okay, that's an interesting history lesson, but how does this actually help me? It helps you because it fundamentally changes how you navigate the process. You are not just shopping for a mortgage. You are shopping for a home loan. You are comparing different loan programs, different interest rates, different fee structures. You are comparing the terms of the quest. You're looking for the wisest, most benevolent king to fund your journey. One who won't load you down with unnecessary burdens. Then when it comes time to close, you understand that the stack of papers you're signing isn't just a formality. You understand that the mortgage note and the mortgage security instrument are the most important documents in the entire pile. You're not just signing your name. You are making a debt pledge. This mindset forces you to pay closer attention. It encourages you to ask smarter questions. What are the specific foreclosure proceedings outlined in this document? What are the penalties for a late payment? Under what conditions can the lender call the loan due? Knowing the difference separates the financial part of the transaction from the legal part. The home loan is a financial product. The mortgage is a legal weapon. The bank is offering you the product, but they are protecting themselves with the weapon. You need to be just as clear-eyed about the reality of the situation. This isn't meant to scare you. It's meant to empower you. A dragon can be a powerful guardian. As long as you respect its power and hold up your end of the bargain, it stays asleep. It protects the lender's interest, which in turn allows them to lend you hundreds of thousands of dollars in the first place. It's a necessary part of the system, but you would never walk into a dragon's lair without knowing exactly where the exits are and what wakes it up. So, to recap the absolute core of it, home loan is the broad term for the money you borrow. Mortgage is the specific legal contract that secures that loan using your house as the collateral. One is the prize, the other is the price of failure. And now that you understand this fundamental power dynamic, you see the game board for what it is. You see the two most important pieces and how they relate to each other. You are no longer just a pawn, but this is just the first layer. As it turns out, there isn't just one type of quest. There isn't just one type of treasure. And there certainly isn't just one type of dragon. The world of home loans is split into two massive, sprawling empires. Two fundamentally different philosophies on how to lend money and secure it. And choosing which empire to align yourself with is the single most important financial decision you will make in this process. One path is well-trodden, governed by a strict set of rules, and favored by those with a long history of financial success. The other path is more forgiving, designed to open the gates to more people, but it comes with its own unique set of tolls and hidden costs. Getting this choice wrong, picking the path that doesn't align with your story, can cost you tens of thousands of dollars, trap you in a home you can't sell, or even prevent you from buying a home at all. So what are these two great empires of lending? And how in the world do you know which one holds the key to your future home? Let's start with a simple, powerful truth that almost everyone gets wrong. A mortgage is not a loan, and a home loan is not a mortgage. They are two completely different things, two separate forces that have to be fused together for you to get the keys to your house. Thinking they're the same is like thinking the lightning and the thunder are the same. One is the raw, silent power. The other is the loud, earth-shaking consequence you can't ignore. The home loan is the lightning. It's the money. It's the massive, silent transfer of capital from a lender's vault into an account that allows you to buy a piece of the American dream. It's the number you see on the pre-approval letter, the 300,000, 500,000, or $1 million that suddenly makes you a serious player in the real estate market. This is the part everyone focuses on. It's the exciting part. It's the fuel. The mortgage is the thunder. It's not the money itself. It's the legal document, the contract, the binding, ironclad agreement that gives the lender terrifying power over you and your property. It's the piece of paper that says, "We gave you the lightning, and if you ever mess up, we will bring the thunder." It's a security instrument. Its only job is to secure the lender's investment. Not to help you, not to be your friend, but to protect the bank. So let's dissect the lightning first, the home loan. A home loan is made up of 3 core components, and you need to understand them like the back of your hand. They are the principal, the interest, and the term. First, the principal. This is the big number. It's the actual amount of money you are borrowing. If a house costs $500,000 and you put $100,000 down, your principal is $400,000. Think of it as the sticker price of the money you're buying. It's the base amount that the entire rest of the deal is built upon. Simple enough. Second, the interest. This is the killer. This is the cost of borrowing the money. It's the fee the bank charges you for the privilege of using their $400,000 to buy a house. This is expressed as a percentage, the interest rate. A lower rate means you pay less to borrow, a higher rate means you pay more. And when I say more, I mean astronomically more. The difference between a 4% interest rate and a 6% interest rate on a $400,000 loan over 30 years isn't a small change. It's over $170,000 in extra payments. That's an entire luxury car. That's a college education. That's a second property in some parts of the country. It's a life-changing amount of money, all hidden inside that one little percentage point. Interest is the silent partner in your homeownership journey, and it takes its cut every single month, for decades. Third, you have the term. This is the loan's lifespan. It's the amount of time you have to pay back the principal plus all that interest. The most common terms in the United States are 30 years and 15 years. A 30-year term means your monthly payments are lower, more manageable, feels easier. But because you're stretching the payments out over such a long time, you end up paying vastly more in total interest. A 15-year term has much higher monthly payments, it's a heavier lift every month, but you pay the loan off in half the time and save an absolutely staggering amount of money on interest. You build equity faster and you own your home free and clear decades sooner. So that's the home loan, the principal, the interest, the term. It's the financial engine of the deal. It's what you get. Now let's talk about what you give. Let's talk about the thunder, the mortgage. When you sign that mountain of paperwork at closing, the most important document you sign is the mortgage agreement. Again, this is not the loan. This is the document that legally ties your property to your loan. It gives the lender what's called a lien on your property. A lien is a legal claim. It's a ghost that haunts your house. It means that while you live there, while you paint the walls and mow the lawn, you are not the true 100% undisputed owner. The lender has a primary claim to your property that supersedes almost everyone else's. Think of it like a pawn shop. You give the pawnbroker your grandfather's watch and they give you cash. You still think of it as your watch, but you can't get it back until you pay back the cash plus their fee. If you don't pay, they sell the watch. The mortgage document is what turns your house into the pawnbroker's watch. You get the cash, the home loan, to buy the house. But the mortgage gives the lender the legal right to hold the title, to have a lien, until you've paid back every single cent. And this is where the most feared word in real estate comes into play: foreclosure. Foreclosure is the legal process a lender uses to execute the power you gave them in the mortgage agreement. If you stop making your loan payments, you are in what's called default. When you default on the loan, you violate the terms of the mortgage contract. And that contract, that piece of paper, gives the lender the right to take your property, sell it, and use the money to pay off the debt you owe them. They can literally seize the roof over your head, the place your kids sleep, the home you've poured your heart and soul into, and sell it on the courthouse steps. That is the power of the mortgage. It's the security. It's the bank's ultimate insurance policy, and you are the one who signs it over to them. So let's put it all together. You don't just get a mortgage to buy a house. You get a home loan, which is the money, and you simultaneously sign a mortgage, which is the legal agreement that uses your new house as collateral for that money. They are a package deal. One cannot exist without the other. The loan provides the funds. The mortgage provides the security. The lightning provides the power. The thunder provides the warning of what happens if that power is misused. Why does this distinction matter so much? Because if you only focus on the loan, the interest rate, the monthly payment, you are only seeing half the picture. You are ignoring the risk. You are ignoring the power dynamic you are entering into. The mortgage document contains clauses and covenants you are legally bound to. Things like needing to maintain the property to a certain standard, or paying your property taxes on time. If you violate these, even if your loan payments are current, you could technically be in default of the mortgage, giving the lender leverage. Understanding this duality is the first step to becoming an empowered homebuyer, instead of a passive participant. You need to negotiate the best possible loan terms, the lowest interest rate, the right term for your financial goals. But you also need to understand the gravity of the mortgage you are signing. You need to know that you are making a sacred promise, and the consequence of breaking that promise isn't just a bad mark on your credit report. It's the potential loss of your home. This isn't to scare you. It's to arm you. Because knowledge in this game isn't just power, it's protection. By seeing the loan and the mortgage as two distinct parts of a single machine, you can analyze your deal from all angles. You can appreciate the opportunity the loan gives you while respecting the threat the mortgage holds. You now understand the fundamental structure of how America finances its homes. You're already ahead of 90% of buyers. But this is just the foundation. Because within the world of home loans, the world of Lightning, there exist dozens of different types. Fixed rate, adjustable rate, FHA, VA, conventional, jumbo. Each one is a completely different kind of financial weapon. And choosing the wrong one for your specific situation is like bringing a knife to a gunfight. A mistake that can leave you financially wounded for years to come. So how do you know which type of loan is your ally, and which one is a trap in disguise? It starts by understanding the battlefield. Think of the world of home loans as being divided into two massive, warring empires. On one side, you have the conventional loans, the private sector, the free market players. On the other, you have the government-backed loans, the cavalry sent by Uncle Sam to help specific groups get into the fight. Your first and most critical decision is choosing which empire to align with. Let's start with the largest and most common force on the field: conventional loans. These are the loans you get from a bank, a credit union, or a mortgage lender without any insurance or guarantee from the federal government. The lender is taking on all the risk themselves. But even within this empire, there are two distinct classes of soldier: the conforming loan and the non-conforming loan. A conforming loan is exactly what it sounds like. It conforms to a set of rules. Whose rules? The rules of the two giants that dominate the American mortgage market: Fannie Mae and Freddie Mac. These aren't direct lenders. Think of them as the massive wholesale buyers of the mortgage world. They buy mortgages from your local lender, which frees up that lender's cash to go out and give more loans to more people. But Fannie and Freddie will only buy loans that fit into their neat, standardized boxes. These boxes have size limits, known as conforming loan limits, which are set every year and vary by county. For most of the U.S. in 2024, that limit is $766,550, but in high-cost areas like parts of California or New York, it can be over $1 million. Why should you care? Because if your loan conforms, it's a golden ticket. It's easier for your lender to sell, which makes it less risky for them. Less risk for them means a better interest rate for you. It's that simple. It's the most common, most straightforward path to homeownership for people with good credit and a decent down payment. But what if you need to borrow more than that limit? What if you're buying a mansion in Beverly Hills or a brownstone in Brooklyn? Then you enter the world of non-conforming loans, most famously known as jumbo loans. These are the big guns. Because these loans are too large for Fannie and Freddie to buy, your lender has to keep that loan on its own books or find a private investor. They are taking on a jumbo-sized risk. And to compensate for that risk, they are going to put you under a microscope. To qualify for a jumbo loan, you'll typically need a stellar credit score, think 700, 720, or even higher. You'll need a larger down payment, often 20 to 30%. And they'll want to see that you have significant cash reserves left over after you close, enough to cover 6 months or even a year of mortgage payments. A jumbo loan is a powerful tool, but it's reserved for the financial elite. Now, with any conventional loan, conforming or not, we have to talk about the 4 most dreaded letters for a new homebuyer. PMI. Private mortgage insurance. This is the single biggest trap for conventional loan borrowers who don't have a lot of cash saved up. Lenders have a golden rule. They want you to have at least 20% equity in your home. Equity is the part you actually own. If you put down 20%, you've met the rule from day one. But what if you only have 5 or 10% to put down? From the lender's perspective, you're a riskier bet. If you default early on, they could lose money after foreclosing and selling the house. So, to protect themselves, not you themselves, they force you to pay for an insurance policy. That's PMI. It's an extra fee, typically ranging from 0.5 to 2% of your loan amount annually, tacked onto your monthly mortgage payment. On a $400,000 loan, that could be an extra $200 to $300 every single month that does absolutely nothing to pay down your loan or build your equity. It's purely the price of admission for not bringing a 20% down payment to the table. The good news? It's not a life sentence. Once you've paid down your mortgage to the point where you have 20% equity, you can request to have it canceled. And by law, lenders must automatically terminate it once you reach 22% equity. But make no mistake, it's a significant cost that can strain your budget for years. So that's the first empire, conventional loans. Powerful, flexible, but demanding. They reward financial discipline with better rates, but penalize low down payments with PMI. But what if you're not a financial heavyweight? What if your credit has a few dings? What if a 20% or even a 5% down payment feels like climbing Mount Everest? That's when you look across the battlefield to the other great empire, government-backed loans. Now this is where a huge misconception trips people up. The government doesn't typically lend you the money directly. You still go to a normal bank or mortgage lender. The difference is the government acts as your cosigner, your powerful ally. They provide the lender with an insurance policy or a guarantee, saying, "Hey, if this borrower defaults, we'll cover your losses." This dramatically reduces the risk for the lender, which allows them to offer incredible terms to people who would never qualify for a conventional loan. There are three main divisions in this army: FHA, VA, and USDA loans. First up, the FHA loan, backed by the Federal Housing Administration. This is the workhorse of the government-backed world, designed to help first-time homebuyers and those with less than perfect finances. Its biggest selling point? You can get into a home with as little as a 3.5% down payment. And your credit score doesn't have to be pristine. You can often get approved with a score in the low 600s, sometimes even lower. This sounds amazing, right? A shortcut to the American dream. But here lies one of the most insidious traps in the entire mortgage landscape. The FHA has its own version of mortgage insurance, called MIP, or mortgage insurance premium. And it is far more punishing than conventional PMI. You pay an upfront premium when you close and you pay a monthly premium. But here's the killer detail. If you put down less than 10%, you will pay that monthly MIP for the entire life of the loan. It never goes away. The only way to get rid of it is to sell the house or refinance into a different type of loan. That small monthly fee can add up to tens of thousands of dollars over 30 years. A permanent tax on your mortgage for the privilege of a low down payment. Next, we have the VA loan backed by the Department of Veterans Affairs. For those who are eligible, active duty military, veterans, and some surviving spouses, this isn't just a loan program. It's one of the best benefits earned through service to the country. It is, without a doubt, the most powerful home loan in existence. The headline feature? Zero down payment. You can finance 100% of the home's purchase price. And the second knockout blow? No monthly mortgage insurance. Ever. The VA guarantees the loan, so there's no need for it. This combination can save you thousands up front and hundreds every single month compared to other loans. But there is a catch called the VA funding fee. It's a one-time fee paid to the VA to keep the program running, and the percentage varies based on your service, down payment, and whether it's your first time using the benefit. It can be rolled into the loan amount, but it's still a cost to consider. However, veterans receiving VA disability compensation are often exempt from this fee entirely, making it an unbeatable deal. Finally, there's the dark horse, the loan many people have never even heard of. The USDA loan, backed by the U.S. Department of Agriculture. And no, you don't have to be a farmer to get one. This program is designed to encourage development in rural and some suburban areas. Like the VA loan, it offers a zero down payment option. But its power is limited by two major gates you have to pass through. First, geography. The property you're buying must be located in a USDA-eligible area. You can check this on their website with a simple map tool, and you might be surprised how many areas just outside major cities qualify. Second, income. Your household income cannot exceed the limit for that area. The USDA loan is specifically for low to moderate income borrowers. If you can pass through both of those gates, you get access to a 100% financing loan with very competitive interest rates and a government-backed guarantee. So there you have it. The two great empires. The private sector conventional loans with their conforming and jumbo divisions, ruled by the 20% down payment and the specter of PMI, and the government-backed loans FHA for accessibility, VA for veterans and USDA for rural areas, each offering incredible benefits, but each with its own unique and critical fine print. You now know the players on the field, but this was just the first step. Knowing the type of army you'll join is one thing. Understanding their strategy of attack is another. Now we have to talk about the rules of engagement itself. Are you signing up for a predictable 30-year trench war? Or a volatile high-stakes gamble? I'm talking about fixed-rate versus adjustable-rate mortgages. This next choice is where fortunes are made and lost, and where one wrong move can turn your dream home into a waking financial nightmare. So let's pull back the curtain on these two financial titans. On one side, you have the fixed-rate mortgage, or FRM. Think of this as the bedrock of homeownership. It's the stoic, reliable, unshakable foundation upon which generations of American dreams have been built. Its defining characteristic, its superpower, is its predictability. When you lock in a fixed-rate mortgage, the interest rate you agree to on day one is the exact same interest rate you will pay on day 10,950, that's 30 years later. It does not change, ever. Your principal and interest payment, the core of your mortgage, is set in stone. It's a constant in a world of variables. This gives you an almost supernatural ability to budget and plan for the next 3 decades of your life. You know exactly what that portion of your housing costs will be in 2035, in 2045, in 2055. It's the closest thing to a financial certainty you can find. Now, a crucial point of clarification that trips up so many homeowners. While your principal and interest are fixed, your total monthly payment can still fluctuate. Remember PITI? Principal, interest, taxes, and insurance. The P and the I are your rock. But the T and the I, your property taxes and your homeowner's insurance, are not controlled by your mortgage lender. Your local government can raise property taxes. Your insurance company can raise your premiums after a string of bad weather in your area. These costs are typically paid into an escrow account managed by your lender, who then pays them on your behalf. So if your taxes or insurance go up, your total monthly payment will go up to cover the difference. But the mortgage itself, the loan you signed for, that rate is your anchor, holding you steady no matter how the economic winds blow. The most common flavors of the fixed-rate mortgage are the 30-year and the 15-year. The 30-year fixed is the undisputed king, the most popular home loan in America, and for good reason. It spreads the loan over a very long period, which results in the lowest possible monthly payment. It makes homeownership accessible. It's the marathon runner, slow, steady, and focused on endurance. The 15-year fixed is its more aggressive, athletic sibling. You're paying off the same amount of money in half the time. Naturally, your monthly payments will be significantly higher, but the trade-off is immense. First, lenders will almost always offer you a lower interest rate on a 15-year loan because their risk is lower. Second, and this is the mind-blowing part, you save a staggering amount of money in interest. Let's run the numbers. Imagine a $400,000 loan. On a 30-year fixed at 7%, your monthly principal and interest payment is about $2,661. Over the life of that loan, you will pay a jaw-dropping $558,000 in interest alone. That's more than the original loan amount. Now let's look at a 15-year fixed. Let's say you get a slightly better rate, 6.5%. Your monthly payment jumps to $3,483. That's a big jump. But here's the magic. Over the 15 years, you'll only pay about $227,000 in interest. By choosing the 15-year option, you would save over $331,000. You would own your home, free and clear, 15 years sooner, and you'd have kept the price of a second house in your pocket. The 30-year is about cash flow. The 15-year is about wealth creation. So, the fixed-rate mortgage is for the planner, the long-term thinker, the family putting down roots. It's for anyone who craves stability and loses sleep over uncertainty. It's the conservative, reliable, and time-tested path to owning your home. But what if you're not a planner? What if you're a risk-taker, an opportunist? What if you see a chance to play the market to your advantage? For you, there's the other side of the coin. The volatile, seductive, and often misunderstood adjustable-rate mortgage, or ARM. If the fixed rate is a rock, the ARM is a chameleon. It changes. It adapts to the financial environment around it. And it almost always starts its life by making you an offer that seems too good to be true. This is called the teaser rate or introductory rate. An ARM will lure you in with an interest rate that is significantly lower than what you could get on a fixed-rate mortgage. For the first few years, your monthly payments are beautifully, deceptively low. This is the honeymoon period. ARMs are usually described with two numbers like a 5-to-1 ARM, a 7-to-1 ARM, or a 10-to-1 ARM. That first number, the 5, 7, or 10, is the number of years your low introductory teaser rate is fixed. It's your safe harbor. For 5 years, a 5-to-1 ARM acts just like a fixed-rate loan. But then the adjustment happens. The second number, the 1, tells you how often the rate can change after the initial period is over. In this case, once every year. And this is where the gamble truly begins. Your new interest rate isn't pulled out of thin air. It's calculated based on a formula, an index plus a margin. The index is a benchmark interest rate that reflects general market conditions, like the SOFR, or secured overnight financing rate. It goes up and down with the economy. The margin is a fixed percentage added on top by the lender. It's their profit, so your rate becomes index plus margin. If the index is low, your rate is low. If the index skyrockets, so does your payment. This sounds terrifying, and it can be. But ARMs have built-in safety features called caps. These are crucial. You'll typically see a structure like 2/2/5. This isn't a secret code. It's your protection. The first number, 2, is the initial adjustment cap. It means that the very first time your rate adjusts, it cannot increase by more than 2 percentage points. The second number, 2, is the subsequent adjustment cap. It means in all the following years, the rate can't go up by more than 2 points at a time. And the last, most important number, 5, is the lifetime cap. It means your interest rate can never, ever increase by more than 5 percentage points above your initial rate. If you started at 5%, it can never go higher than 10% no matter what. These caps create a ceiling, a worst-case scenario that you can plan for. So who in their right mind would take this gamble? The ARM is perfect for someone with a specific strategy. Maybe you know you're going to be transferred for work in 4 years. You could take a 5-to-1 ARM, enjoy the incredibly low payments, and sell the house long before the first rate adjustment ever hits. Or maybe you're a young doctor just finishing residency. Your income is low now, but you know it's going to double or triple in 5 years. You can use the ARM to afford a home now, and by the time the rate adjusts, you'll have more than enough income to handle a higher payment. You are betting on your own future success. The danger, of course, is when the plan goes wrong. This was a central villain in the 2008 financial crisis. People were given ARMs with low teaser rates they could barely afford, with no realistic plan for what would happen when those rates reset to a much higher level. They were betting the value of their house would keep rising, allowing them to refinance before the adjustment. When the market crashed, they were trapped. The payments exploded and foreclosure followed. It was a catastrophic failure of both lending standards and borrower understanding. Today's ARMs are much more regulated, but the fundamental risk remains. You are betting against the future. You're betting that rates will stay low, or that your personal circumstances will improve. A fixed-rate mortgage is a statement of certainty. An adjustable-rate mortgage is a question mark. So, the choice is a profound reflection of your financial philosophy. Do you choose the predictable path of the fixed rate, paying a little more for the priceless commodity of peace of mind? Or do you take the calculated risk of the adjustable rate, leveraging a lower initial cost with the hope of selling, refinancing, or earning more before the gamble is called due? You've chosen your loan structure, the very engine of your home purchase. But that engine won't even start without the right fuel. Lenders have a holy trinity of numbers they obsess over. A financial fingerprint that tells them if you're a safe bet or a liability. I'm talking about your credit score, your debt-to-income ratio, and your down payment. And understanding how these three numbers truly work together is the key that will either unlock the door to your dream home or slam it shut in your face. So let's start with the first and arguably the most famous number in your entire financial life, your credit score. Think of your credit score as your financial storyteller. It's a single 3-digit number, usually between 300 and 850, that tells a lender the entire history of your relationship with debt. It answers the one question that keeps bankers up at night. If we lend this person a very large sum of money, what are the odds they'll actually pay it back on time? A high score, say 760 or above, whispers a story of reliability, of on-time payments, of responsible borrowing. A low score, maybe below 620, screams a tale of missed payments, high balances, and potential risk. Now, why does this story matter so much? Because it directly translates into cold, hard cash saved or spent. A lender rewards a good story with a lower interest rate. They see you as a safe bet. They reward a risky story with a higher interest rate to compensate for the chance you might default. The difference isn't trivial. We're not talking about a few dollars. Let's make this real. Imagine two friends, Alex and Ben. Both are buying identical houses for $400,000. They both have the same income and put down the same 10% down payment, so they're both getting a home loan for $360,000. The only difference? Alex has a fantastic credit score of 780. Ben, on the other hand, has a more average score of 650. It's not terrible, but it tells a different story. The lender offers Alex an interest rate of 6%. His monthly principal and interest payment is about $2,158. Now Ben, with his 650 score, is seen as a bigger risk. The lender offers him a rate of 7.5%. His monthly payment is $2,517. That's a difference of $359 every single month. That's a car payment. That's a full week of groceries for a family. That's over $4,300 a year, just vanishing into thin air because of a 3-digit number. But here's the part that should truly terrify you. Over the life of a 30-year mortgage, Alex will pay a total of about $417,000 in interest. Ben, with his higher rate, will pay over $546,000 in interest. That's a staggering difference of over $129,000. $129,000. That's a college education, a fleet of cars, a life-changing retirement fund. It's the cost of buying the exact same house, dictated almost entirely by the story their credit score told. This is why your credit score isn't just a number. It's a lever that can move financial mountains. Now let's move to the second pillar, the one that's less about your past and more about your present. This is your debt-to-income ratio, or DTI. If the credit score is your financial storyteller, your DTI is the reality check. It's the here and now stress test. It answers a simple, brutal question. Based on what you earn versus what you already owe, can you actually afford this new giant mortgage payment without suffocating? Your DTI is calculated by taking all your monthly debt payments, your student loans, your car payment, your credit card minimum payments, any personal loans, and dividing that total by your gross monthly income, which is your income before taxes. The result is a percentage. For example, if you have $2,000 in monthly debt payments and you earn $6,000 a month before taxes, your DTI is 33%. Lenders live and die by this number. It tells them how much of your monthly paycheck is already spoken for before you even think about paying for a house, for groceries, for gas, for life. Generally, lenders want to see a DTI of 43% or lower, including your new potential mortgage payment. Some will go as high as 50% for certain loan programs with strong compensating factors, like a massive credit score or a huge down payment, but 43% is the magic number for most conventional loans. Why? Because the data shows that once people cross that threshold, the risk of default skyrockets. They are house poor. Every dollar is accounted for. There's no room for error, no cushion for a broken water heater or an unexpected medical bill. The bank isn't just protecting itself with this rule. In a way, it's protecting you from yourself, from taking on a financial burden so heavy it could crush you. A low DTI tells the lender you have breathing room. You have a financial buffer. It shows that adding a mortgage payment to your life won't push you to the brink. A high DTI, even with a perfect credit score, is a massive red flag. It signals that you are over-leveraged, that your financial life is stretched thin, and that one small emergency could cause the whole thing to snap. Finally, we arrive at the third pillar, the down payment. This is the simplest to understand, but it's surrounded by the most myths. Your down payment is the amount of your own money you bring to the table. It's your skin in the game. It's your upfront investment in the property, and it shows the lender two critical things. First, that you have the financial discipline to save a large amount of money, and second, that you are personally invested in the success of this purchase. If you have your own money on the line, you're far less likely to walk away if times get tough. Now let's shatter the biggest myth in American real estate. You do not need a 20% down payment to buy a house. Let me repeat that. The 20% down payment is not a law. It is a benchmark. It is the gold standard for one very specific reason. It allows you to avoid something called private mortgage insurance, or PMI. PMI is one of the most misunderstood costs in home buying. It is an insurance policy that you pay for, but it protects the lender, not you. If you put down less than 20%, the lender sees you as a higher risk. So, they force you to buy an insurance policy that will pay them back if you stop making your payments and the house goes into foreclosure. It's a fee for not meeting the 20% gold standard. This fee is typically rolled into your monthly mortgage payment and can cost anywhere from 0.5% to 1.5% of your total loan amount per year. On that same $360,000 loan, that could be an extra $150 to $450 tacked onto your payment every single month for a service that gives you zero personal benefit. So yes, avoiding PMI by putting down 20% is a fantastic financial goal. But for millions of Americans, saving up $80,000 for a $400,000 house is an impossible dream. And the system knows this. That's why a universe of other options exists. FHA loans, backed by the government, allow down payments as low as 3.5%. VA loans for veterans and active duty service members can require 0% down. USDA loans for homes in eligible rural areas also offer 0% down. And many conventional loan programs now exist that allow qualified buyers to put down as little as 3%. The down payment is a trade-off. A smaller down payment means getting into a home sooner, starting to build equity, and escaping the rent trap. But it also means a larger loan, a higher monthly payment, and likely paying for PMI for several years until you've built up 20% equity in your home. There is no single right answer, only the right answer for your specific situation. So you see, these three pillars, credit score, DTI, and down payment, don't exist in a vacuum. They work together, creating a complete portrait of you as a borrower. They can even compensate for one another. Have a credit score that's just okay? A larger down payment and a very low DTI can help convince a lender you're still a good bet. Don't have a lot saved for a down payment? A stellar 800 credit score and an income that gives you a tiny DTI can unlock those low down payment loan options with the best possible terms. The lender is looking at the total picture, the balance of your financial story, your current financial reality, and your commitment to the purchase. You now understand the three numbers that define your borrowing power. You know what they mean, why they matter, and how they can cost or save you a fortune. You've cracked the code of qualification. But getting approved is only half the battle. Now you're standing at a crossroads, faced with a dizzying menu of loan types that sound like a foreign language. Fixed rate, ARM, FHA, conventional, 15-year, 30-year. Choosing the right product is just as critical as having the right profile. And picking the wrong one can be a 30-year mistake that quietly drains your wealth, year after year. In the next part, we are going to demystify every single one of them. Alright, let's open up the toolbox. Because that's what these different home loan types really are. They're specialized tools, each designed for a specific job, a specific person, and a specific financial situation. Using the wrong tool won't just make the job harder, it could break the entire project. First up, we have the king of the jungle, the one you hear about most often, the conventional loan. Think of this as the reliable all-purpose hammer in your toolbox. It's not backed or insured by the federal government. It's a straight-up agreement between you and a private lender, like a bank or a credit union. Because the government isn't co-signing for you, the lender is taking on all the risk. And what do they demand in return for that risk? They demand a strong borrower. Typically, this means a credit score of 620 at the absolute minimum, but you'll get much better deals in the 740 and up club. They'll also want to see a solid debt-to-income ratio and a verifiable employment history. Now let's bust the biggest myth about conventional loans: the 20% down payment. You do not always need 20% down. That idea is a fossil from a bygone era. Today, many lenders offer conventional loans with as little as 3% or 5% down, especially for first-time homebuyers. But, and this is a massive but, if you put down less than 20%, you will have to pay for something called private mortgage insurance, or PMI. PMI is basically an insurance policy that you pay for, but it protects the lender, not you. If you default on your loan, PMI is what helps the lender recoup their losses. It's the price of admission for bringing less cash to the table. The good news? Once you reach 20% equity in your home, you can request to have that PMI removed. So the conventional loan is for the buyer with good to excellent credit, stable income, and at least some savings who wants the flexibility to eventually shed that extra insurance cost. But what if your credit isn't perfect? What if you haven't had years to save up a big down payment? That's where our next tool comes in. This is the FHA loan. FHA stands for the Federal Housing Administration, and their job is to make homeownership more accessible. An FHA loan is insured by the government. This is huge. It's like having the US government as your very impressive reference on a job application. Because the government is promising to cover the lender's back if you default, lenders are willing to relax their standards. This means you can potentially get an FHA loan with a credit score as low as 580, and you only need a 3.5% down payment. This is a game changer for millions of Americans. It's the loan that opens the door when the conventional loan slams it shut. But, as with everything in finance, there is no free lunch. The FHA loan comes with a significant catch, and it's called Mortgage Insurance Premium, or MIP. It's similar to PMI on a conventional loan, but with two brutal differences. First, you pay a big chunk of it up front at closing. Second, and this is the killer, if you put down less than 10%, that monthly mortgage insurance payment stays with you for the entire life of the loan. It never goes away unless you refinance into a different type of loan. It's a permanent passenger in your car, and you're paying for their gas every single month for 30 years. So the FHA loan is a powerful tool for access, perfect for those with lower credit or savings, but you have to be aware of the long-term cost of that lifetime mortgage insurance. Next, we have a loan that isn't just a tool. It's a badge of honor. This is the VA loan. Guaranteed by the U.S. Department of Veterans Affairs, this is an earned benefit for eligible active duty service members, veterans, and surviving spouses. And frankly, it is the most powerful home loan product on the market, period. The headline feature? 0% down. You can buy a home with literally no down payment. Let that sink in. On a $400,000 house, that's the difference between needing to save $14,000 for an FHA loan and needing to save zero. But it gets even better. VA loans do not have monthly mortgage insurance. There's no PMI, no MIP, nothing. This alone can save you hundreds of dollars every single month compared to a conventional or FHA loan with a low down payment. The credit requirements are also typically more lenient. Now, there is a one-time VA funding fee, which varies depending on your service and down payment amount, but it can often be rolled into the loan itself. The VA loan is a profound thank you for service, a financial superpower that gives our military members a massive advantage in the housing market. If you are eligible, it is almost always your best possible option. Now let's venture off the beaten path to a loan that many people don't even know exists. The USDA loan. This is the U.S. Department of Agriculture's secret weapon for revitalizing rural and suburban America. Like the VA loan, the USDA loan has an almost unbelievable feature: 0% down payment. Again, no down payment required. It's designed to help moderate to low-income borrowers buy homes in eligible rural areas. And when you hear rural, don't just picture a farm in the middle of nowhere. You would be shocked at what the USDA considers rural. Many small towns and suburban neighborhoods just outside of major city limits qualify. You can literally go on the USDA's website, type in an address, and check its eligibility on a map. The catch? There are two. First, your household income cannot exceed a certain limit, which varies by region. This program is for people who need it, not for high earners. Second, the property itself must be located in one of those designated eligible areas. But if you meet the income requirements and you're looking to live outside of a dense urban core, the USDA loan is a golden ticket. It's an incredible opportunity to achieve homeownership with little to no money out of pocket. Finally, we enter the heavyweight division. What happens when you're in a high-cost area like San Francisco or New York, and the house you want costs $1 million or more? A regular conventional loan won't work. They have size limits, set by the government, called conforming loan limits. Anything above that limit is considered a jumbo loan. A jumbo loan is exactly what it sounds like: a giant loan for an expensive property. Because these loans are so large, and they aren't backed by government entities like Fannie Mae or Freddie Mac, they represent a huge risk for the lender. To compensate for this risk, they roll out the velvet rope and only let the most qualified borrowers in. For a jumbo loan, you'll need a stellar credit score, often 700 or much higher. You'll need a very low debt-to-income ratio, and you'll need a significant down payment, typically 10 to 20% or more. Lenders will also want to see that you have substantial cash reserves, enough money in the bank to cover 6 to 12 months of mortgage payments, even after you've paid your down payment and closing costs. A jumbo loan is the financial equivalent of a custom-tailored suit. It's designed for a very specific, high-net-worth clientele buying high-value properties. So there you have it: the workhorse conventional, the accessible FHA, the powerful VA, the hidden gem USDA, and the heavyweight jumbo. Each is a key designed for a different lock. Your job isn't to become an expert in all of them. Your job is to identify the one key that was forged specifically for you. But hold on, choosing your loan type is only half the battle. It's like picking the make and model of your car. Now you have to decide what kind of engine to put in it. And this decision will dictate how your loan performs over the next 3 decades. Are you going to choose the steady, predictable engine that runs at the exact same speed no matter what? Or are you going to opt for the high-tech, adaptable engine that could save you a fortune in the short term, but carries the risk of spinning out of control down the road? This is the battle between fixed-rate and adjustable-rate mortgages, and understanding it is the difference between a smooth ride and a catastrophic crash. So let's get in the driver's seat. Your first choice is the engine that will power your entire homeownership journey. Do you go for the reliable V6 sedan that will perform exactly the same day in and day out for 30 years? Or do you opt for the turbocharged high-performance sports car that gives you an incredible burst of speed off the line, but might require a skilled driver to handle the curves ahead? This is the core of the fixed-rate versus the adjustable-rate mortgage debate. Let's start with the dependable sedan, the fixed-rate mortgage, or FRM. The name tells you everything you need to know. The interest rate is fixed. It's locked in. It is set in stone from the day you sign the papers until the day you make your final payment, whether that's 15 or 30 years from now. It doesn't matter if the economy booms, busts, or flies to the moon. Your principal and interest payment will be the exact same number in year 27 as it was in month 1. This is the bedrock of financial planning. It's the ultimate sleep-at-night option. You can budget for the next 3 decades with near-perfect certainty. If you see yourself in this home for the long haul, raising a family, putting down deep roots, the fixed-rate mortgage is your fortress of predictability. Within this fortress, you have another choice: the 30-year versus the 15-year term. The 30-year fixed is the most popular mortgage in America, and for good reason. It stretches the loan out over a longer period, resulting in the lowest possible monthly payment. This frees up cash flow for other investments, emergencies, or just living your life. It's the marathon runner's choice. But there's a cost for that comfort. You pay a lot more in interest over the life of the loan. The 15-year fixed, on the other hand, is the sprinter. Your monthly payments will be significantly higher because you're paying the loan off in half the time. But the trade-off is staggering. First, you'll almost always get a lower interest rate from the lender because their risk is lower. Second, and this is the big one, the amount of interest you save is life-changing. Let's run some quick, brutal numbers. A $400,000 loan. On a 30-year fixed at 7%, you'd pay roughly $558,000 in interest alone over 3 decades. Your total cost is almost $1 million. On a 15-year fixed at 6.5%, your total interest paid would be around $223,000. That's a difference of over $335,000. That's a college education. That's a retirement fund. That's financial freedom, bought and paid for by 15 years of disciplined, higher payments. The 30-year gives you breathing room. The 15-year gives you wealth. Now let's walk over to the other side of the showroom to that flashy sports car, the adjustable rate mortgage, or ARM. The ARM is designed to lure you in with what's called a teaser rate or an introductory rate. For an initial period, typically 3, 5, 7, or 10 years, your interest rate is fixed, and it's usually lower than what you could get on a 30-year fixed mortgage at the same time. This is the appeal. It makes your initial monthly payments seductively low. You can afford more house or have more cash in your pocket. Feels like you're winning. But after that introductory period is over, the adjustable part kicks in. Your interest rate is no longer fixed. Instead, it resets periodically, usually once a year, based on the movements of a specific financial index plus a margin. Suddenly, your payment isn't predictable anymore. It's tied to the chaos of the global economy. If rates go down, your payment could go down. Hallelujah! But if rates go up, and they often do, your payment could skyrocket. This is the moment that catastrophic crash we talked about becomes a real possibility. To prevent a total meltdown, ARMs have safety features called caps. There's a periodic cap, which limits how much the rate can increase in any single adjustment period, and a lifetime cap, which sets a ceiling on how high the rate can ever go over the life of the loan. But let's be clear. These caps are like the guardrails on a mountain pass. They might stop you from going over the cliff, but they won't stop you from having a terrifying, stomach-churning ride right along the edge. So who on earth would choose this roller coaster? The strategist. The person who has a plan. Maybe you know you're going to be transferred for work in 4 years. You could take a 5-to-1 ARM, enjoy the low payments for those 4 years, and sell the house long before the first rate adjustment ever hits. Or maybe you're a young doctor just finishing your residency. Your income is modest now, but you know it's going to double in 3 years. You take the ARM to get into a house, knowing you can easily absorb any payment increases later, or refinance into a fixed-rate loan once your income is higher. The ARM is a tool. In the hands of a disciplined, informed buyer with a clear exit strategy, it can be a brilliant one. In the hands of someone who just wants the lowest payment today without thinking about tomorrow, it can be a disaster. So we have our loan types: the steady fixed rate and the dynamic adjustable rate. But that's just one layer of the onion. The next question is, who is backing your loan? This is where you hear a whole new alphabet soup of acronyms: FHA, VA, USDA, and conventional. Let's start with the government-backed programs. These are not lenders. The government doesn't give you the money. Instead, they insure the loan, telling the private lender, hey, if this borrower defaults, we've got your back. This insurance dramatically reduces the lender's risk, allowing them to offer loans to people who might not otherwise qualify. First up is the FHA loan, backed by the Federal Housing Administration. This is the workhorse of the first-time homebuyer market. Its biggest selling point is the low down payment requirement, as little as 3.5% down. They're also more forgiving on credit scores. If your credit is less than perfect, an FHA loan might be your only ticket to homeownership. The catch? You have to pay for that insurance in the form of a mortgage insurance premium, or MIP. And unlike other loans on most FHA loans, that MIP payment sticks around for the entire life of the loan. It's a trade-off: easier access in exchange for a permanently higher monthly payment. Next is the VA loan from the Department of Veterans Affairs. If you are an active duty service member, a veteran, or an eligible surviving spouse, this is one of the greatest benefits you have earned. The headline feature of a VA loan is often a 0% down payment. That's right, you can buy a home with no money down. On top of that, there is no monthly mortgage insurance. This is a powerful program designed to honor those who have served the country. Then there's the USDA loan from the U.S. Department of Agriculture. And no, you don't have to be a farmer. This program is designed to promote homeownership in less dense parts of the country. Think rural areas and even mini suburbs. If you meet the income eligibility requirements and the property is in a designated USDA-eligible area, you could also qualify for a zero down payment loan. Finally, we have the big one, the conventional loan. This is any loan that isn't insured by the federal government. But that doesn't mean it's the Wild West. Most conventional loans still have to conform to a set of standards established by two giant, government-sponsored enterprises, Fannie Mae and Freddie Mac. These are the titans of the mortgage industry. They don't make loans directly, but they buy trillions of dollars worth of mortgages from the lenders you deal with. By buying these loans, they free up the lender's capital so they can go out and make more loans. It's the engine that keeps the entire system running. And to be a part of this system, the loans have to be conforming, meaning they meet Fannie and Freddie's rules on loan size, credit scores, and debt-to-income ratios. This is why a 20% down payment is the magic number you always hear about. It's the traditional threshold to avoid paying private mortgage insurance, or PMI, on a conventional loan. So you've chosen your engine, fixed or adjustable. You've chosen your chassis, FHA, VA, USDA, or conventional. You have the vehicle. You've studied the map. Now it's time to actually turn the key and start the application process. This is where the paperwork mountains rise up, where your entire financial life is put under a microscope. It's a process called underwriting, and it's where countless dream deals fall apart. But they don't have to, because there's a clear path through the maze. A checklist of do's and don'ts that can mean the difference between getting the keys to your new home and getting a soul-crushing denial letter just days before closing. Let's call this period the pre-closing gauntlet. It's that nerve-wracking stretch of time between getting your offer accepted and actually getting the keys. You've been pre-approved, you've found the house, and you think the hard part is over. But this is precisely where the most catastrophic last-minute mistakes are made. This is where your lender's underwriting department puts your entire financial life under a high-powered microscope. Your job during this period is to be as financially boring as humanly possible. You need to become a ghost in the financial machine. So let's start with the absolute ironclad do not pass go list of don'ts. These are the financial landmines that will blow up your deal. First, and this is the biggest one, do not, under any circumstances, make any large purchases on credit. I know the temptation is overwhelming. You're about to own a home. You start picturing that perfect sectional sofa, the new stainless steel refrigerator, maybe even a new car to put in the new garage. Stop. Right there. When your lender pre-approved you, they did it based on a snapshot of your debt-to-income ratio, or DTI. This is the magic number that tells them how much of your monthly income is already spoken for by debt payments. By financing a $5,000 furniture set or a $30,000 car, you are fundamentally changing that number. You are throwing a grenade into the underwriter's calculations. Their system will see this new debt, your DTI will spike, and suddenly, from their perspective, you can no longer afford the house you were approved for just weeks ago. A red flag goes up, alarms go off, and your loan can be denied. It happens every single day. That sofa can wait. Your old car is fine for another few months. Your priority is the house. Second commandment: do not change jobs, or quit your job, or even switch from a salaried position to a commission-based one within the same company. Lenders are not looking for excitement. They are looking for stability. They want to see a consistent, predictable, and verifiable employment history. 2 years at the same job is the gold standard. When you switch employers mid-process, you reset that clock. The underwriter now has to re-verify everything. They have to question your long-term stability in the new role. Is it a probationary period? Is the income guaranteed? It introduces doubt, and doubt is the enemy of underwriting. If you are presented with an incredible, life-changing job offer during this time, you need to speak to your loan officer immediately, before you accept. They can guide you on whether it's possible to proceed, or if you need to pause your home search. But voluntarily making a move right now? It's like changing horses in the middle of a raging river. Just stay put until the deed is in your hand. Number 3 is more subtle but just as deadly. Do not open or close any credit accounts. Don't apply for that new credit card that offers airline miles. Don't pay off and close that old card you never use thinking you're being responsible. Here's why. Every time you apply for new credit, it triggers a hard inquiry on your credit report, which can temporarily ding your credit score by a few points. A few points might not seem like a big deal, but if you're on the borderline for a certain interest rate, it could be the difference that pushes you into a higher cost loan or out of qualification entirely. And closing an old account can actually hurt your score too. It can reduce your overall available credit, which increases your credit utilization ratio. Another key metric. It also shortens your average age of accounts. The underwriting system is automated to look for these changes. It will see the new inquiry or the closed account, and it will force a manual review of your entire file. Don't give them a reason. Put your credit on ice. Fourth, and this one trips up a lot of well-meaning people, do not make large, undocumented cash deposits into your bank accounts. Maybe you sold your old car for cash. Maybe your parents gave you a generous cash gift to help with the down payment. The problem is, in the eyes of a lender, a large, sudden cash deposit with no paper trail is a massive red flag for one thing: money laundering. It's also a sign of an undocumented loan from a friend or family member, which is a debt they haven't accounted for. Any funds you use for your down payment or closing costs must be sourced and seasoned. That means the lender needs to see exactly where the money came from and see that it has been in your account for a period of time, usually at least 60 days. If you receive a gift, it needs to be accompanied by a formal gift letter, a paper trail from the giver's account to yours. Don't just show up with a bag of cash. Every single dollar has to be accounted for. Finally, number 5. Do not co-sign a loan for anyone. Not for your sibling's new car. Not for your cousin's student loan. When you co-sign, you are not just being a helpful guarantor. In the eyes of the law and the lender, you are 100% responsible for that debt. It goes directly onto your credit report and is factored into your debt-to-income ratio just as if it were your own loan. Even if you never make a single payment, that monthly payment amount is now counted against you, potentially disqualifying you from your own mortgage. It's a simple, avoidable error that can completely derail your homeownership dreams. Okay, that was the scary part. Now let's flip the script. Let's talk about the dose, the proactive steps you can take to ensure a smooth, stress-free path to the closing table. First and foremost, do stay in constant communication. Your loan officer, your processor, and your real estate agent are your team. They are on your side. If you have a question, ask it. If something changes in your financial situation, tell them immediately. Hiding a problem will only make it worse when the underwriter inevitably discovers it. Open, honest, and frequent communication prevents surprises and allows your team to solve small issues before they become deal breakers. Second, do become a document gathering ninja. During underwriting, you will be asked for documents. Lots of them. The most recent pay stubs, 2 months of bank statements, your tax returns, and then you'll be asked for them again. Or for a letter explaining a specific deposit. The speed at which you respond is critical. Underwriters work on dozens of files at once. The files that are complete and easy to work on get pushed through the fastest. The ones waiting on a single document get put to the bottom of the pile. Set up a folder on your computer. Scan and save everything. When your loan processor emails you at 10 a.m., asking for your latest bank statement, your goal should be to send it back to them by 10:15. Be organized, be fast, and be responsive. This alone can shave days or even weeks off your closing timeline. Third, do keep meticulous records of everything. Every conversation, every email, every document you send. This isn't about distrust. It's about diligence. In a complex transaction with multiple parties, things can get lost in translation. Having a clear record of who you spoke to, when, and what was discussed can be invaluable if a misunderstanding arises. It protects you and ensures everyone is on the same page. Fourth, do start preparing for your closing costs early. Your down payment isn't the only cash you'll need. Closing costs can range from 2 to 5% of the home's purchase price. This covers a whole host of things: the appraisal fee, title insurance, loan origination fees, attorney fees, and prepaying for your property taxes and homeowner's insurance. Your lender will give you an estimate, but it's crucial to have these funds ready and seasoned in your bank account, separate from your down payment. Don't be caught scrambling for thousands of dollars at the last minute. And finally, the most important do of all. Do your best to relax and trust the process. This is a stressful time, but you have a team of professionals guiding you. You've done the hard work of saving, building your credit, and getting pre-approved. You've followed the rules, avoided the pitfalls, and provided everything that's been asked of you. Now you have to let the gears of the system turn. Fretting over it every second of every day won't make the underwriter move any faster. Focus on packing, planning your move, and getting excited about your new home. By avoiding those critical mistakes and embracing these proactive steps, you transform yourself from a passive, anxious buyer into an empowered partner in the transaction. You're no longer just hoping for the best. You're actively steering your ship toward a successful closing. You've navigated the maze, you've survived the gauntlet, and now only one thing stands between you and those keys. The final boss battle, the closing table itself. This is it. The culmination of weeks, maybe months of searching, negotiating, and stressing. You walk into a conference room. There's a title agent, maybe your real estate agent, and a stack of paper so high it looks like a monument to deforestation. This isn't just paperwork. It's the final series of spells you must cast to claim your prize. Your weapon: a simple blue or black ink pen. Your enemy: fatigue, confusion, and the sheer volume of legal jargon. First up, the heavyweight champion of closing documents, the closing disclosure or CD. You've seen a version of this before, at least 3 business days prior to this moment. This is federal law. The know before you owe rule. The government literally passed a law to prevent lenders from pulling a fast one on you at the last second. Your mission, should you choose to accept it, is to compare this final CD line by line with the last loan estimate you received. Are the numbers the same? Is the interest rate what you locked in? Are the closing costs what you expected? This is your final chance to raise a red flag. Don't be shy. Don't feel rushed. The people in that room work for you. Ask questions about any fee you don't understand. A $1,000 document processing fee? That wasn't there before? Speak up. This is your money, your future. Defend it. Once you've slain the closing disclosure beast, you'll face the promissory note. This document is deceptively simple. It's the IOU. It's your personal, legally binding promise to repay the loan. It states the total amount you borrowed, the interest rate, your monthly payment amount, and where and when to send the payments. When you sign this, you are saying, yes, I borrowed hundreds of thousands of dollars, and I solemnly swear I will pay it all back plus interest. It's a powerful moment. It's the moment the debt becomes truly legally yours. There's no collateral mentioned here. It's just your word, your signature, your promise. But the bank needs more than a promise. And that brings us to the very heart of our entire journey, the core question of this series. You'll be handed either a document titled mortgage or one titled deed of trust. And here, my friends, is the grand reveal. For all this time, we've used home loan and mortgage interchangeably, just like everyone else. But they are not the same thing. The home loan is the abstract concept of the money you're borrowing, the debt itself, which you just acknowledged with the promissory note. The mortgage or deed of trust is the security instrument. It's the document that physically connects that loan to your property. It's the bank's collateral. It's the legal paperwork that says, If I break the promise I made in the promissory note, the lender has the right to take this house back through a process called foreclosure to get their money back. Think of it like this: the loan is the what. What did you get? Money. The mortgage is the what if. What happens if you don't pay it back? The house is seized. That's the real difference. A home loan is a debt. A mortgage is a lien, a legal claim against a property that secures a debt. So when you say you're paying your mortgage, you're technically paying your home loan, and by doing so, you're fulfilling the terms of the mortgage agreement. Whether you sign a mortgage or a deed of trust depends entirely on what state you're in. They accomplish the same goal, but the foreclosure process can be different. With a mortgage, a lender typically has to go to court to foreclose, which is called a judicial foreclosure. With a deed of trust, the process can often happen outside of the court system, called a non-judicial foreclosure, which is usually faster. You don't get to choose. It's determined by state law. But now you know. You're not just signing a random piece of paper. You are signing the very document that gives the bank the ultimate power over your property if you fail to pay. This knowledge doesn't make it less scary, but it makes you more powerful, because you understand the gravity of the agreement you are making. After signing that, you'll sign a flurry of other documents: tax forms, escrow disclosures, affidavits confirming your name and identity. Your hand will start to feel like it's going to fall off. You'll sign your name, your spouse's name, you'll initial pages until the ink starts to blur. This is the grind, the final push, and then it's over. The title agent will gather up the skyscraper of paper. They'll tell you congratulations. You'll wire your closing costs and down payment, or hand over a cashier's check for an amount that makes your stomach do a backflip. And then someone slides a set of keys across the table. They feel impossibly light for what they represent. They are the keys to your future. The keys to late-night pizza on the living room floor because you haven't bought a table yet. The keys to painting a wall whatever color you want. The keys to a place that is unequivocally, legally, and beautifully yours. You've done it. You have leveled up from home buyer to homeowner. But the game isn't over. A new level has just begun. Your first payment is usually due on the 1st of the month, about 30 to 45 days after closing. You'll get a letter from your new loan servicer, which may or may not be the same company as your original lender, with instructions on how to set up your online account. Do this immediately. Set up autopay. The last thing you want is a late payment on your brand new loan because a letter got lost in the mail. Remember pity, principal, interest, taxes, and insurance. If you set up an escrow account, your servicer will handle paying your property taxes and homeowner's insurance for you from the portion of your monthly payment they set aside. You'll get a statement once a year showing you the activity. If taxes or insurance go up, your monthly payment will go up too. It's your responsibility to review this. Stay engaged. Homeownership isn't a set-it-and-forget-it investment. So let's take a step back and look at the mountain we just climbed together. We started with a simple question. What's the difference between a mortgage and a home loan? And we discovered the answer isn't just a dictionary definition. It's a journey through the entire American home buying process. We learned that a home loan is the money, and a mortgage is the legal document that secures that money with the property itself. We learned that understanding this language, pre-qualification versus pre-approval, fixed rate versus adjustable, conventional versus FHA, is the key to unlocking power in a process that's designed to be confusing. You now know that your credit score is your financial passport. You know that a down payment isn't just about hitting a 20% magic number, but about managing your monthly costs and private mortgage insurance. You know that shopping for a lender is just as important as shopping for a house. You understand that the loan estimate is your crystal ball, and the closing disclosure is your final exam. You've transformed from a hopeful window shopper into an educated, empowered consumer. You're no longer a passenger in this process. You are the pilot. You know which questions to ask, which documents to scrutinize, and which red flags to watch out for. This knowledge is your armor. It protects you from bad deals, from predatory lenders, and from the anxiety of the unknown. Buying a home will likely be the single largest financial transaction of your entire life. You wouldn't perform surgery on yourself after watching a 30-second video, so why would you enter into a 30-year financial commitment without understanding the rules of the game? You didn't. You invested the time. You learned the language. And now you are ready. If this journey has been valuable to you, don't keep it to yourself. The greatest gift you can give someone who is about to embark on this path is the gift of knowledge. Share this with your friends, your family, your coworkers, anyone who has ever dreamed of owning a home but was too intimidated to start. You can be their guide. You can give them the confidence they need to take that first step. Because in the end, that's what this is all about. It's not just about loans and liens, interest rates and escrow. It's about building a life. It's about creating a space for yourself and your loved ones in the world. It's about turning a house, a structure of wood and nails and drywall, into a home. A place of safety, of memory, of growth. A place that is yours. Thank you for taking this journey. Now go build your future.